Hi guys, welcome back to my channel Ask Parul, and Ask stands for Always Seek Knowledge. And in this channel I focus on sharing my knowledge on getting professional growth, helping people gain financial security and personal development to help and inspire people to live a well-rounded and successful life. So if any of these three topics resonate with you, then do subscribe to my channel and look into the playlist of my channel for other useful videos. I have linked the three playlists in my description link so that you can check out. So, welcome to this new investment series where we will explore the world of investing and help cover some investment basics, talk about different kind of and different types of investments, look into the pros and cons of each one of them, compare different kinds of funds so that you can make informed decisions for a secure financial future. This is episode 1. I'll make further episodes down the line, but in this first episode we will talk about the investment basics, what's investing, the types of investments. In particular, I'll focus on the two types of investments, which is stocks and bonds. In second episode, I will be talking in detail about stocks and bonds and compare those two just to see the pros and cons of each one of them. And in the third episode, I'll talk in detail about the third kind of investments, which is mutual funds. We'll compare different kind of mutual funds, right from actively managed funds, index funds, and ETFs, which is exchange traded funds. So don't get confused. I'll try to make things as simple and as basic as I can. And I'm pretty sure that by the end of this series, you will have a much better and deeper understanding and you can deep dive into the world of investing. So, let's start this episode 1 of this investment series. And like I always say, that if you do like my content, then do subscribe to my channel and do share it with other people as well who you feel can benefit from this analysis. So let's dive in. Section number 1 is about what is investing. So before we jump into the different type of investments, let's quickly cover what's investing. So investing is the process of putting your money to work for you with the goal of earning a return over time. There are various investment options such as stocks, bonds, real estate. Each comes with its own level of risk and potential return. And remember that the higher risk usually means higher potential return, but also it means that there is a greater chance of loss as well. So section number 2 we have is the different types of investments. Now let's explore some common type of investments. Broadly speaking, there are many different type of investments such as the interest income that you earn from the high interest savings account, REITs, which is real estate investment trusts, stocks, bonds, mutual funds. I've already made a video, two videos actually, on the high interest savings account. The link is in my description box below. Go check that out. It's really, really important that you understand that because it's one of the most basic and straightforward way of creating passive income. And also, I'm going to share the link in my description box below. Also, do check out a small video on ETFs versus stocks, which is exchange traded funds versus stocks, so that you can have a basic understanding. But we will talk in detail about ETFs in this series as well in the further episodes. And like I said at the start of the video, for this episode 1, I am mainly focusing on the first two types of investments. So, number 1, we are going to talk about stocks. So, when you buy a stock, you are purchasing a small ownership or equity stake in a company. Stocks can generate returns either through the capital appreciation when your stock grows in value over time, or through regular dividend or distributions. And if you're wondering what is dividend and distribution, I've also made a video. I'm going to give the link in my description box, or you can look at my playlist as well. So, coming back to stocks, like I was saying, when you buy a stock, you're actually purchasing a tiny slice of the company. It could be one or more shares, and the more shares you buy, the more of the company you own. And I'll just take one example. Okay, so let's take one example of stocks. Let's say a company A has a stock price of $50 per share and you invest 2,500, which is 50 shares for $50 each. Now, imagine over several years the company consistently keeps performing well because you are a partial owner. The company's success is also your success, and the value of your shares will grow just like the value of the company. So let's assume if its stock price rises to $75. So initially it was $50, now it becomes $75, which is a 50% increase. The value of your investment would also rise 50% from 2,500 to 3,750. So you could then sell those shares to another company, or maybe you can take out your profit of $1,250 as a profit. All right, so hopefully that example was helpful. So that example showed us the profit that you can earn from stock. Of course, the opposite is true as well. So for example, if the company performs poorly, the value of your shares could fall below what you bought them for. In that instance, if you sell them, then you would be losing the money. And one of the things that you can do is actually to keep stop loss. So generally, most of the brokerage firms will provide you a stop loss function where you can fix a certain value, and let's say if the stock price goes below that value, then this functionality would automatically stop trading, and then you can decide if you really want to stock further, I'm sorry, or you want to take out whatever profit or loss that you have generated. So that's about stocks. Now we are going to take a look at the second investment type, which is bonds. Now, bonds are slightly different to stocks because bonds are debt securities issued by corporations or governments. Now, when you buy a bond, you are essentially lending money to the issuer in exchange for interest payments and the return of your principal at the bond's maturity date. So essentially, what it means is that bonds are a loan from you to the company or to the government. There is no equity involved, as like in stocks, there is an equity involved. In bonds, there is no equity involved, nor are there any shares to buy. Put simply, a company or government is in debt to you when you buy a bond, and it will pay you the interest on that debt or that loan that they are taking from you for a set period, after which it will pay back the full amount, that is the principal you bought the bond for, plus the regular interest income that you are getting from it. And let's take one another example, as just basically to understand a bit more about the bonds. Okay, so let's say that you buy a bond for 2,500 and it pays you 5% annual interest for 10 years. Let's assume the maturity date is 10 years. That means that every year you would receive $125, which is 5% of 2,500 in interest payments, which is typically distributed evenly throughout the year. And after a duration of 10 years, which is your maturity date, you would have earned 1,250, which is, every year you're receiving 125. So at the end of 10 years, you would be receiving 1,250 in interest as profit. And like I said, interest is typically distributed evenly throughout the year. So depending on whether it's annually or monthly or quarterly, but you will get that interest, and you would also get back your initial investment of 2,500 as well. So this is how generally a bond would work. All right. So we just took a look at one example of the bonds. Now with bonds, you usually know exactly what you are signing up for, and the regular interest payments can be used as a source of predictable fixed source of income over long periods, and the duration of the bond typically depends on the type of bond that you buy, but it could range from a few days, let's assume that from 30 days to as high as 30 years as well. And likewise, the interest rate that you earn, typically known as the yield, will vary depending on the type and duration of the bond. There are generally two types of bond. Either they are government bonds or they are corporate bonds. The government bonds are usually a bit more risk free but the corporate bonds are not completely risk free. So that's one small difference between the fixed term or the term deposits or the savings account, the interest that you earn from the savings account, because that's where it is completely risk free, and likewise the government bonds as well. But corporate bonds, even though they are, I would not say as risky as a stocks, but definitely they are not completely risk free. So let's assume if the company goes bankrupt during the bond period, let's assume you've taken for 10 years and the company goes bankrupt, you will stop receiving interest payments, and you may not also get back your full principal as well. So do ensure that you check the credit rating of the company, and usually a company's ability to pay back debt is reflected in its credit rating, which is assigned by credit rating agencies such as Moody's or Standard and Poor's. So do check that out. Otherwise, you can look for, if you're looking for more safer investments, then maybe look for government bonds or term deposits and high interest savings account. I've made one video comparing the term deposit or the fixed deposits with the high interest savings account. But despite the risk, I think corporate bonds, like I said, are still a lot more predictable than stocks or mutual funds. So that's the video where we will conclude episode 1. In this episode, we looked at what is investing. We also looked at different types of investments. We started looking at stocks. We looked at one example. Then we looked at bonds. We also looked at one example. And in episode number 2, which will follow shortly, is where we will compare stocks versus bonds. We'll see what are the pros and cons of each of these approaches. And in the upcoming series, we'll also take a look at mutual funds and compare different kinds of funds. So that's it for episode number 1. If you are new to my channel, then do subscribe to my channel, like and share, and stay tuned because I have episode number 2 coming in shortly. Thank you.